23, 24, last time I looked, I think that year there's about 1,300 companies that raised SAS. And about half of that would have been through a fund. The allocation is 250K if you're SIS eligible. All these funds, including ours, ask you to go and get advanced assurance from HMRC that you are eligible for SIS. To do that now, they used to be able to do it directly and then find a fund. Now you need to find an individual or a fund, and someone with experience has done it before. So it could be an individual, to basically be the person that HMRC can see. Because if you don't have a person, they won't give you the advance assurance. Think about it, you got 250K of funding where you are able to sell shares up to that 250K, and a buyer of those shares, if they're a SIS fund or a British taxpayer, can get a tax break up to 50% off, on that. That is valuable real estate. So if you're going for a fund and not using angels, not using Uncle Bill's money who wants SIS, you have to realize that these funds need a minimum amount of SIS to play. General rule of thumb is they probably want minimum of half your allocation. And funds like Hatch, PAR, Fuel, they will insist on taking all of it. So your angel, your Uncle Bill, your ex-colleague, they will get their SIS if you give it all to those people. SIS funds basically look like funds, but really they're a collective of angels. So they're investing and for a single nominee for their collection of angels. We have 60 in our SIS fund, 60 individuals. They have told us to find the best possible deals. Most SIS funds have got some kind of focus. The general ones and the specialist ones. So we're a specialist, we just do AI first. It's a dozen investments a year. There are ones that specialize like BritBots in robotics. There's ones that just do digital health. There's about maybe 10 specialists. Conception X does PhD driven. So you've got these smallish ones. But the bigger ones like SFC, Hatch, Fuel, they're generic. They'll do everything. They may have a regional priority because they may have taken government money to back that. And the government's agenda in pre-seed rounds is, please, no one do it in London. Please, everyone do it outside. And the problem is, we're still looking at 70% of people raising their first fund are in London. And despite all the incentives, despite all the extra money, Innovate UK has just come back on a program and said no one in London or the Golden Triangle will be funded in the next 3 months from Innovate UK, because that's how much we need to get out of London. People don't say it's so much of innovation is focused in the capital. If you followed where the entrepreneur is, it'd be London and a few cities.
Interesting.
And that's despite billions being spent by government to try and get the stuff out in the regions. So most of the general ones don't have a specialism. We do AI first. Other thing about SIS funds, they charge the founders. They're not just the only ones, the EIS funds as well, the VCTs, all of them charge the founders. You charge them for all your own legal and operation costs. Ends up always being around 5%. Surprising that. The only ones that seem to be not really are the Americans who don't actually. So some funds want to be more American. We charge 5% of the amount we put in. Some funds charge 10, some charge 15. Why do we do that? The investors won't pay much of a management fee. And if you're going through an intermediary to raise money from high net worths, the intermediary takes all the management fee. When people talk about tax breaks in the States has a standard $50,000 tax break. Every American's allowed to get $50,000, lose it in a qualifying business, any SME in the States each year. Tax breaks you can get on investment in Britain are so much more limited, and that's why we have SIS. Actually, the lowest one will be about 3, the maximum one will be about 15. And you might want to ask your SIS fund. Even angels will sometimes charge funds for basically NED costs to attend board meetings or kind of et cetera. So there is little bits of cost. So when I did a SIS fund in 2017 to 2020, my regulation costs per year were about £20,000 I had to pay. They're now £140,000 a year. There's a hell of a lot more regulation costs that you have to do. Virtually all of it is to protect the investors, actually. as opposed to invest and protect the founders. Have his SS allowance 250, the EIS allowance is about 10 million. They should understand it, read about it. They should know that convertible loan notes are not SIS or EIS compliant. You should know that for whatever stupid reason, the ASA is now only 6 months. So it has to convert within a 6-month period, which makes it a lot less useful. You must know that basically the amount of allocation of money was SIS eligible, whether it's from angels or these funds, is very seasonal. The fact over half the money will be deployed in the last quarter of the financial year. Because a lot of people fundraise when people know what tax they're going to pay in that year. And they say, you're going to pay this tax. So when it comes to founders, it's a pre-seed round. I mean, the big thing about the SFCs and the Hatches of the world, and PARs and Fuel, because they're generic and because they will do an AI, robotic, consumer tech, basically, marketplace, tend to keep their valuations really quite tight. They'll all do pre-revenue if the founders are really super smart and have good credentials. But if not, if you really want to get a pre-seed, have an MVP, have a couple of paying customers, at least customers that are trying the product out, design partners that will pay in a couple of months' time.
Okay.
B2B, I prefer to B2C. Companies that have got more revenue, get better valuation, are hotter. The valuation in hardware is a lot lower than software. And when you go to EIS funds, so they are normally wanting to go late seed, Series A and above, they are very financial orientated. The average check we write is about 750K, of which SIS will be about 150. Put a smaller check in if you have no SIS, because we won't be able to use our SIS pot. One thing I would say, if you want to speak to people like us that can write bigger checks, so people like SFC or Hatch, the maximum check they'll write will be 250 or 300 if you get a bit of government money, and that's it. So if you need more to build an 18-month runway or 24-month runway to get into market, get your product working, get commercial metrics, be in a position to raise the next round. And if you basically go to these funds and give away all your SIS, these blended funds like us are less likely to invest. So be aware of that. And then you can come out and then you can raise, because you've got a bit of traction, the team's competed, you built the product, the pipeline looks good, and you can go to. Most of the EIS funds do act a bit differently, and the VCTs particularly, from a standard VC, but they market themselves as the same. We differentiate ourselves in the market. There's about 70, 80 funds competing for talent, UK market. I would say about half the funds at this stage do vibe assessments. So they don't really look at much, speak to the founders, probably check them out on LinkedIn, like the kind of space. They do due diligence.
Yeah.
And that's where most founders break down. It's not actually on the pitch anymore. Most of them are quite well good in the pitch. The deck's normally now pretty. It's actually when we try and validate any of the information, turns out to be